Right. We have more or less discussed the financial intermediaries' role in our last few lectures, and of course, last lecture was a recording, and hope you all have gone through the discussion that we continued from the previous class, and this one, what we are trying to now start is more or less getting into the business end of the program. So the business end of the program more or less comes with central bank, and central bank in the sense I'm starting with the discussion of the most sought after, if not most looked after central bank in today's context, the Federal Reserve, the US Central Bank, and its broad operational perspective. But while discussing the Federal Reserve system, I will also parallelly bring in Sri Lanka, Sri Lanka's Central Bank of Sri Lanka's circumstance into the discussion. So that way we'll be able to compare, and also we would be discussing Bank of England, Bank of Japan, Reserve Bank of India, some flavor of some of these major central banks also into the discussion. But what you have to now see is we are gradually moving into the business end of the discussion, and we'll be able to kind of clarify greater details as we move on in this section. And then we will move into the broader concepts like money supply process and things like that, that will shape up the major role these central banks play in shaping the economies in line with their mandates, the legislative powers that they have been through legislations, what powers that they have been empowered to deliver to bring in the orderly economic conditions in those economies. But what you have to see here is, as I already said, among the most important players in financial market throughout the world, it is the central bank. And you can argue from a various perspective the role of the central banks in the financial market. It's very broad and at the same time very important, because they are the ones basically responsible for the discharge of monetary policy. And this is in a sense, in some countries you probably see a central bank, and some countries you will call a reserve bank, and in some places it could be a monetary authority, right? So the Reserve Bank of India as example, okay, Federal Reserve, right? Then you see Monetary Authority of Singapore, right? Then you see Central Bank of Sri Lanka, Central Bank of whatever the name that you wanted to call it. You will see this type of arrangement, okay? But what is interesting here is the actions of these central banks that influence the interest rates, okay? The amount of credit available in an economy, and overall money supply volumes, okay? All of which that we discussed, the interest rates, the amount of credit, the money supply, and there may be other kind of forward-looking directions the central banks kind of direct to the economy. These not only directly impact the financial market, but also broadly impact the aggregate output and the inflation. What is this output is everybody's per se, it is the GDP that people are looking at, the size of the economy, right? And then you see the inflation, that is the price level. So the aspects that we discussed would influence the overall financial market and the aggregate output and the inflation. So after all, whatever the central bank does has an influence on the market and then to the overall real economy that you probably see in terms of the output numbers, and also people's most looked after variable in the form of inflation, the price level. So you see these aspects in day to day from various sources, various angles, and we will get into those stuff as we discuss this topic in this section, and probably a few more lectures that we will follow up as we continue. Okay, so to understand the role of the central banks, and particularly the role they play in financial markets and the overall economy, okay, we need to kind of get a feel on how these organizations, if not these central banks, work, right? So then we also want to see who controls central banks and determines their actions, right? While I discuss these things, I will bring in a lot of examples of recent times, so that would make you kind of really feel the role of the decision making within central banks, who controls and who determines the actions of these institutions, okay, and what drives, if not motivate, their behavior, and who basically has the power within the central bank in terms of making these decisions. Okay, so in this particular lecture, we will look at the institutional structure of major central banks, and the focus, as I said, mainly on the Fed Reserve System. Okay, so the perspective, which is the most important central bank in the world in today's circumstance. And then, of course, we also start focusing on the formal institutional structure of the Federal Reserve itself, and gradually move into examine more relevant informal structures that determine where the main decision making happens within the Federal Reserve System itself. Okay, by understanding these elements within the Federal Reserve System, we will be able to kind of move into get a kind of a feel how these decisions are made within these central banks that ultimately influence the most important variables in an economy. And also then we look at several major central banks, as I said, and how they are broadly organized. But we will not spend time on kind of discussing the structural aspects of other central banks, but broadly look at how they've been kind of structured out. And also, as I said, I will bring in Sri Lanka's case at each and every point for you to kind of see a comparison and also to have a kind of a feel. So we will move on this basis. And as I always mention, if you have any clarification, please feel free to drop me a message, so we'll be able to follow up on that basis. Okay, so when you see the origins of the Fed Reserve System, okay, so when you see Fed Reserve System, that name itself bring in a plurality. That itself says it's not a single institution, it's a system, collection of Fed Reserve banks, right? So we will get into those details, but in most of the countries that when you say a central bank, you probably get a feel it's a single institution. Okay, maybe you have regional offices operating, branch offices operating, that's fine. But in the case of Fed Reserve, the US, it's a collection of central banks. We will detail out as we move on. Okay, so origin of the Fed Reserve in US initially had resistance for establishment of a central bank. Initially, in US, they were not necessarily happy to establish a central bank because they worried about centralized decision making, because they wanted to see decentralized decision making arrangements, because US is a collection of states, different states. You probably see, if you look at a US map, you will see these states. So those states have powers to define their activities. So they worried, okay, why we give a kind of a centralized role to a one single central bank, and through which they probably be losing their decentralized decision making possibilities. So they had the fear in the initial stages, and also they had the distrust because of this moneyed interest, because they felt that, I mean, when it comes to moneyed interest, probably people who in a kind of a central bank setup would not necessarily look at their state-based, if not decentralized, interest for that particular state alone, but they would be broadly taking the overall interest of the economic benefits and driving the decision. So this had kind of resistance coming from US at the initial stages of establishing a central bank in the in US. So then, of course, they had these problems because we look at these bank failures and things like that at different times in the history, as we were discussing our previous 2 lectures. So they also felt there is no lender of last resort, right? When the banks were in trouble, there is nobody to fall back, right? From a centralized agency, through them that they could have liquidity facilities availed. So they wanted to see that while the resistance was there, one school of thinking was, okay, we still don't have a lender of last resort. And you see the nationwide bank panics on a regular basis in US at different intervals. And we broke down those at different periods and explained in greater details at certain major events happened in global and US history. So then we looked at these bank failures in numbers, right? So at times of these failures, they were not having anybody to fall back. And remember, the FDIC, Federal Deposit Insurance Scheme, also not available at that time, that initial stages. That came in early part of 19, in fact, 19, after the First World War, like when you see a FDIC arrangement established following the problems that they have seen with the bank failures after the First World War and then the Great Depression. So you see these developments. So they had these problems in the form of bank panics. And then, of course, the 1907 panic that was so severe that the public, although the power bases in these states still had resistance, the public was convinced a central bank is required for the US. And the US Central Bank Act was enacted in 1913. It is not a kind of a centuries old. Of course, it is now about 107 years old. But what you are simply seeing is, it is not like in other parts of the world, particularly Europe, when it comes to the history as far as the Federal Reserve arrangement is concerned. So the Federal Reserve system was established with the Federal Reserve Act in 1913. And then, of course, this system itself bring in check and balances to give certain type of decision making in a centralized arrangement, but at the same time, these decisions being checked and the kind of a neutrality or the balance being brought in through a regional state kind of arrangement. So we will get into those stuff as we move on. And also some decentralized arrangements for influencing decision making in the overall Federal Reserve setup itself. So you see these arrangements in the US case. US had this resistance, and then of course the convincing arguments by public to see that somebody has to play a role of lender of last resort. And then of course the 1907 crisis that convinced the people to kind of move into a central bank arrangement in US, and the Federal Reserve system established with 1913 Federal Reserve Act with check and balances in place, and also decentralized arrangement for decision making. Okay, so when we are moving into the structure of the Federal Reserve system, right? So the people who drafted the Federal Reserve Act wanted to see the power being diffused, not on a kind of a centralizing of power, but to some extent the power being diffused along regional lines, because they had resistance. You all now understand the fact that they had resistance at regional level. So they wanted to also diffuse this power along these regional bases between private sector and the government, among the bankers, business people, and the public. So they wanted to see all stakeholders being brought into the equation of decision making. So the people who wanted to draft this act, they were mindful to the extent that different stakeholders in the US regional setup being brought into the equation without kind of, leaving out these players, through which they would be having much more difficulties in convincing the public and getting the support to run a much more successful central banking setup at that time. So they brought in kind of, both public sector, private sector, that means the government and the private sector, because you will see with the ownership of these Fed Reserve banks, it's mainly the private sector and the banks who are owners end of the day. Okay, they bring in bankers, then of course the business community in those regional places, and also the general public. So it's a kind of a broader setup in terms of how they wanted to bring in the arrangement to kind of get the support of all these stakeholders. Okay, so this initial diffusion of power has resulted in the evolution of the Federal Reserve System to see it's not a centralized one entity, but collection of major systems across the so-called Federal Reserve System itself. So the US Federal Reserve System is mainly comprised of, okay, as I said, Federal Reserve banks. Federal Reserve banks, we will detail out in the next few slides. So you see the Federal Reserve banks there, and then you see the Board of Governors of the Federal Reserve System. So that's the chairman and the most important decision-making lot, Federal Reserve Board of Governors. Okay, so the Federal Reserve banks, Federal Reserve Board of Governors. Then you see Federal Open Market Committee, FOMC, the most influential in terms of implementing Federal Reserve Board of Governors decision is the FOMC. Their actions would immediately inject or absorb many billions, in fact trillions of dollars from the market, and through which much more influential in which way the interest rates would behave. So with the interest rate, you would see exchange rate would fluctuate, and everybody would look upon how the Federal Open Market Committee play out in terms of Federal Reserve's Board of Governors decisions. And then, of course, you see Advisory Council and then member commercial banks. So it's a kind of arrangement in US where you see the Fed Reserve being established along regional lines. Yes, there are different Fed Reserve banks across different regions. Then you see a Board of Governors. They are sitting in often in Washington, DC, right? And then they have a setup where the chairman, that's like a governor in easy parlance that you are familiar with, and the board members. And then you see a Fed Reserve Open Market Committee, FOMC. Then you see Advisory Council, and then of course member banks, because these commercial banks are the ones who own the Fed Reserve banks in the respective regions. So you see it's a system. But when it comes to a Central Bank of Sri Lanka, you probably do not see a system like what you are seeing in the Fed Reserve. So it's not collection of central banks in this country. It is a single central bank, but you see branch offices operating. You see in Matara, you see in upcountry, right? You see in Trincomalee, you see in Northern Province, right? You see the branches. These are branch operations, okay? But not different central banks operating in different regions in Sri Lanka. So it's a single central bank in this country. And Sri Lanka's case, the Board of Governors are equal to the so-called monetary board. The governor is the chairman, Okay, in US case, the board of governors has a chairman. He's the governor in Fed Reserve's arrangement. Okay, they call him the chairman, right? Mike Powell now, right? So previously Janet Yellen, and prior to that you saw Bernanke. So there are people, very established names in terms of the operation of central bank in US. And in Sri Lanka's case, you see it's the monetary board, very similar to a board of governors. Then you see Federal Open Market Committee. You can call it in Sri Lanka's case, you have a Monetary Policy Committee, MPC, right? So it is not necessarily as Federal Open Market Committee in US case, because in Sri Lanka's case, MPC still could kind of, recommend, but ultimately it's the board of monetary board is the one who makes the decision. In the case of US, board of governors, yes, they make the decision, but FOMC also has significant influence in terms of membership and all. It's the same board of governors are again members in the FOMC with few more participants. In Sri Lanka's case, MPC is not the monetary board members there in MPC, but it's an advisory role play. But in the US, then you have another setup called Federal Advisory Council, and then member commercial banks. So we will move on with greater details as we discuss this. Any questions you wanted to discuss? You can write it down and pass it to me so I can follow up quickly. Right. So you see the arrangement in the case of US, it's broadly the Federal Open Market Committee, FOMC, that's the main arm through which the decisions being passed on. But the Board of Governors, the most influential set of policymakers who drive the overall US financial system, and also through them, the global financial system, one could argue. So in the case of Sri Lanka, it's the monetary board, and then of course the decisions being followed up by respective line departments. And in the US, you see the different central banks at regional levels, and being centralized through a board of governors. That's the kind of a centralized arrangements that they are working. But in Sri Lankan case, there is no regional central banks or anything. It's the branches for basic regional kind of activities to carry out. So you see this setup, and what you are simply seeing here is the establishment of the structure here in this chart, the figure one that I'm now seeing in the screen. So you also can see that. So what's the structure and responsibility for different policy tools that we would be discussing? Because what you are simply seeing in yellow here, the policy tool, that's 3 component plus non-conventional policy tools that we would be discussing going forward. These are the major instruments through which central banks all around the world influence economic activities, right? So how this been taken in terms of influence in economic activities through different decision-making arrangement. And here you see the Federal Reserve System itself. Then we will take up these one by one, okay? And then we'll try to elaborate with details. You can pass on if you have any further clarifications required, and then we can discuss those in details. Right. So you see here the Board of Governors, right? So most influential decision makers in terms of financial markets anywhere in the world is here in this Board of Governors, right? So you see it's comprised of 7 members, right? Including the chairman. In the case of US, he's the governor of the central bank. You're probably familiar with other countries and other setups. So the 7 members include the chairman and appointed by the President of United States and confirmed by the Senate. And in case of Sri Lanka, you can see it's the monetary board. You see 5 members. Governor is the chairman of the monetary board and officially the head of the institution, CEO of the Central Bank of Sri Lanka, right? And in the case of US, it's the chairman, and they have 7 members, right? In the case of Sri Lanka, it's the governor. It's appointed by the president through the recommendation of the minister in charge of the subject finance. Okay, and then Sri Lanka's case, you see the secretary to the treasury is an official member. Whoever occupies the position of secretary to the treasury, that means secretary to the Ministry of Finance, becomes a member by occupying the position of secretary to the treasury, right? So you see the 2 members in the case of Sri Lanka's arrangement being appointed by the president. Secretaries to ministries also appointed by the president in the case of Sri Lanka. And then you see the 3 appointed members in the case of Sri Lanka representing various interests. They've been recommended by the parliamentary committee, right, for high positions, and through them they've been cleared and appointed for the membership in the central bank's monetary board. So it's a 5-member committee in the case of Sri Lanka. In the US, it's the 7 members appointed by the president and confirmed by the US Senate, right? So this 7-member US Board of Governors are very, very crucial and important, and we will get into those details. And then you see in US, okay, so you see in US, as I was mentioning, it's a collection of central banks, and in numbers it is 12. It is 12 Fed Reserve banks in US. Okay, so when you see US, you will find as we move on, these central banks are located along different regional arrangements, mainly representing different states in US, but it's not necessarily all states. I mean, the federal government in US, that's the federal setup is there. So each and every state do not have a Fed Reserve Bank, but few states, yes, and then few states pool together and have one Fed Reserve Bank for that constituency. So you see here, each these Fed Reserve banks has 9 directors, okay, and among these directors they appoint a president who is the head of that Fed Reserve Bank for that constituency. But interestingly, when it comes to this 9, 3 directors to this Fed Reserve regional based Fed Reserve arrangement, 3 directors being appointed by the Fed Reserve Board of Governors. The balance 6 being appointed by so-called member banks. So it is the commercial banks in those localities or the regions, they send their directors to their nominees to the central bank's board of directors for that particular region, numbering to 9, numbering to 6, and 3 from the board of governors, and altogether 9-member board of directors for each Fed Reserve Bank in US, and these Fed Reserve banks numbering to 12. So you see 12 Fed Reserve banks in US, each comprise 9 directors, 3 being appointed by Fed Reserve Board of Governors and 6 being appointed by member banks. Member banks are commercial banks, right? So then you see among these 9, one being appointed as president. Okay, so you see the role of these presidents of these Fed Reserve banks invariably in Board of Governors membership that we will discuss as we move on. And then you see these Fed Reserve banks also has advisory councils. Okay, so mainly this advisory council for the Fed Reserve banks comprise of 12 members, mainly bankers. So this 12-member advisory council for Fed Reserve banks coming from each Fed Reserve district represents 1 member there. So numbering to 12. 12-member advisory councils, they advise these Fed Reserve banks. Okay, so then these Fed Reserve banks also play a role in FOMC, Fed Reserve Open Market Committee. As I said, it's very, very important in terms of driving global interest rates, global exchange rate behavior in terms of US dollar. So because the actions of this FOMC would drive US interest rates. When the US interest rates changes, immediately the US currency strength also changes along with the other macro or economic policy variables. So ultimately that would influence the US economic health plus the rest of the world. Because when the US economic circumstances change, rest of the world's economic circumstances also change. And rest of the world's action in terms of reserves and other related assets, and even the assets being invested in rest of the world also start kind of moving around with changes happening in US economy. So it's a very common and very much established phenomenon in recent, particularly over the last 30 years or so, right? So the influence of this Federal Open Market Committee is so much to the extent, okay, it comprises of actually the all 7 members of Board of Governors, right, plus presidents of, that means the heads of those Fed Reserve banks, amounted to 5. They amounted to 5 out of these 12, but always the Fed Reserve New York's president is a member of FOMC, and 4 others on a rotational basis. So you have 12 Fed Reserve banks. 5 presidents of these 12 would be members of FOMC. So FOMC has 12 members, 7 coming from the Board of Governors, 5 Fed Reserve presidents, and one of these presidents are always Fed Reserve New York's president, because the main Fed Open Market Operation desk is located in New York. Wall Street is in New York, right? The financial center, the global financial center is in New York. There are other centers around the world, London, Frankfurt, to lesser extent in terms of Hong Kong, Singapore, Dubai, various places. But still, you see, the center in terms of financial markets operations all throughout the world is there in New York. So the Fed Reserve most important open market operation desk is in New York Fed Reserve Bank. So the president of Fed Reserve New York is a member of the Federal Open Market Committee. and 4 other presidents. They come on a rotational basis. So they being represented by all these regions at different times. When I see these federal advisory councils, right, as I said, it's 12-member representing each district. In Sri Lanka too, you see a consultative committees. It is mainly playing the advisory role. These consultative committees, you see for Monetary Policy Committee, MPC, you see a Monetary Policy Consultative Committee also there. Right? So the members in the Monetary Policy Consultative Committees are mainly the industry experts, okay, professionals, and also the academics, because who is heading in Sri Lanka's MPCC now is none other than Professor Srimal Abhiratna. Right? He's playing as the chairman of the MPCC, and similarly we also have a Financial System Stability Committee in Sri Lanka, right? So that looks after the regulations of banks and overall financial system and financial system stability, right? So then you see a consultative Financial System Stability Consultative Committee also in Sri Lanka. So you have a Monetary Policy Consultative Committee, Financial System Stability Consultative Committee in the case of Sri Lanka. And in other central banks also, similar advisory consultative arrangements being set up. So they bring in industry inputs into the equation. Right? So you can imagine that all these agencies, all these central banks, including Federal Reserve, do not necessarily make decision without having industry, if not the expertise and the inputs coming from different stakeholders. Of course, the central banks have staff. They do all the technical work required and do a lot of research on the basis of how the directions are. But ultimately, it's these board of governors and the monetary board in the case of Sri Lanka, they are the ones who are responsible. And for their decision making, all the inputs are coming from these type of setups. But ultimately, what matters here is the policy tools that's available with the central banks. And it's a reserve requirement, open market operation, discount rate. I mean, you can have different names all around the world. In Sri Lanka's case, we call it statutory reserve requirement. And it's again, it's nothing different to the reserve requirement. It's the same thing. Open market operation, we also call it open market operation, OMO, right? It's no different. Discount rate is the policy interest rate, right? Or you see a lender of last resort facility interest rate in the case of Sri Lanka. Penal rate also there, that's a different type of a discount rate. So these elements play a very important role in driving the economic activities in any country. And on top of these policy tools that I just mentioned, all three, these are conventional policy, monetary policy tools, conventional monetary policy tool. There are non-conventional monetary policy tools also now in use. We will discuss those stuff, right, as we move along with these discussions. Right. Any questions before I move on? Right. So you see now, as I was explaining to you in terms of how the arrangement in the case of Fed Reserve, you already know there are 12 Fed Reserve banks. Okay. So when you see these Fed Reserve banks, what you simply see in this figure, when you look at these blue dots, that represent a Fed Reserve bank for that particular region. And as I already said, it's numbering to 12. And I already mentioned to you, these were also not for each states in US, but few states pooled together, and they have made these Fed Reserve banks. And you can see here the blue dot, for instance, in San Francisco, that's number 12, 12th Fed Reserve Bank in this figure. Number 1 is here in Boston. This is West Coast, this is East Coast. East Coast is more busier in terms of number of Fed Reserve banks in US, because at the time of establishing the US Fed Reserve System in 1913, the US, the economic activities, international trade, and most of the economic activities were concentrated towards this side of the country, that is East Coast of US, simply because this is where you see the Atlantic Ocean, where the Titanic sank, and the other side of the Atlantic Ocean is the Europe. Europe was the main trading partner of US, and most of the economic activities during world wars and immediately after the world wars happened in this part of the world. So the most of the economic activities in terms of US and Europe was happening here, and there's a concentration of more Fed Reserve banks in this side of the country. And that's why you see the entire this west side has only one, whereas most of the Fed Reserve banks, right, almost equivalent to about 6 is concentrated here. And you see Boston, New York, Philadelphia, right, Cleveland, Richmond, right? Then you see Atlanta, Chicago, St. Louis, Dallas, Kansas, Minneapolis, and then San Francisco. These blue dots are the Fed Reserve banks. And then along these blue dots, you also see the red star, that is the Board of Governors of the Fed Reserve System, that is here in Washington. And of course, New York, that's where the FOMC's epicenter, the world's financial center, but the decision makers of the Board of Governors, they sit here in Washington, because this is where the US administrative decisions, apart from Federal Reserve's Board of Governors, is taken place, because it's all political, and all other sets of White House, the Senates, everything is here in Washington. So it's easy to have the administrative policy collaboration and coordination in Washington. And of course, the decisions being implemented across major financial centers and mainly in New York. So you see here, the star is the Board of Governors in Washington. Black dots are the Fed Reserve branch cities. Sorry, the blue dots are the Fed Reserve banks. And then for each Fed Reserve bank, you see Fed Reserve branch cities. Those are black dots. It's numbering quite much. In San Francisco Fed Reserve Bank, for this part of the country, there are few states. Okay, So these white lines that you are seeing these are state boundaries in US, different states, right? For instance, in Sri Lanka, you may call it provinces, fine. But you see these different states have different branch cities, but one central bank. In the case of this West Coast, where the San Francisco, that's where the Fed Reserve Bank is located. But here in East Coast, for instance, in Boston, there's a Fed Reserve Bank, no branch cities. Of course, in New York, you have a Fed Reserve Bank and a branch city in Buffalo. Right, so the setup here is number of branch cities at different Fed Reserve Banks arrangement in that part of the country, and particular Fed Reserve Bank is responsible for this boundary drawn in red line. So this boundary lines for Fed Reserve Banks define a particular place, this area, and known as a Fed Reserve district. Okay. So you see here in US, you don't see two US another main components like Alaska somewhere here above Canada and Hawaii in Pacific Ocean. So those are also part of San Francisco Fed Reserve Bank. But what you are simply seeing here is the Fed Reserve District along these red lines being defined to represent this entire region. And here, like number one, it's this region. So you see a very, very clear arrangement in terms of regional lines to diffuse the fear and resistance at the time of establishment of Fed Reserve Bank in US, and also representation in terms of decision making by bringing FOMC members, right? So amounting to 12, 7 from the Fed Reserve Board of Governors and 5 presidents of these Fed Reserve Banks. Always New York president is a member of FOMC, and 4 others representing the balance 11 Fed Reserve Banks on a rotational basis. And then you see advisory councils in US, right? And then each Fed Reserve Bank has 9-member director board, 3 being appointed by the Fed Reserve Board of Governors, 6 by member banks. So that's the kind of setup. Whereas in Sri Lanka, as you already know, it's 5-member monetary board. Okay, the governor and the secretary to the treasury are members, apart from 3 appointed members in the case of Sri Lanka. And other countries, we will look at European Central Bank. We will look at those as we discuss this lecture, and we can discuss and elaborate as we move on. Any questions? Right. So you see these details, and then of course we'll get into details now, and we will gradually move into the business end of this central banking. And you see here these Fed Reserve Banks. These are quasi-public. It is public-private in a way, quasi-public. It's not fully public institutions. Okay. And you see it's owned by private commercial banks in the district that are members of the Fed system. You have seen the district boundaries, red lines. So within that, you see the commercial banks in operation. They are the members and they are the owners of these Fed Reserve Banks for that particular district. And as we already know, these member banks select 6 directors for each Fed Reserve Bank for that particular district, and the balance 3 appointed by Board of Governors. And often these directors, this 9-member director board, comprise of the professional bankers, yes. Then you see prominent industry representatives, right? And also board of governor appointed 3 members, right? But they are not employees or stockholders or employees of banks. So it's kind of independency related consideration. So why sometimes you see prominent leaders of different industries being looked at? Because in different states in US, there may be different type of industry that's become prominent. In some part of US, you find gas and oil industry is the biggest. In some part of the US, it is wheat and agriculture. In some part of the US, it is weaponry, and then you see all these chemicals and related things, right? So different interests, different specialization, and different economic activities. So they bring in these Fed Reserve Board also to represent that particular state's local interest. Otherwise, the decisions that they make would not match the decisions that requires by this local setup. So to represent that at the initial stages of arrangement itself, the Fed Reserve Act recognized the representation in line with local arrangement. That is why they call it, they wanted to diffuse the power along regional lines, so through which they have brought in different arrangements, right? So it's more or less give into local expertise based on the different economic activities that's remain prominent in those regions in US. So it's a good setup. One can call it, I mean, that brings in their consideration into the decision-making table, and through which that represent that presentation that goes to the Fed Reserve Board of Governors. They ultimately makes the broader decisions in terms of US interest rates, and then of course what type of monetary policy actions to be implemented through Federal Open Market Committee. And also you see these member banks, they elect 6 directors for each district Fed Reserve Bank. Okay, so to apart from 3 members appointed by Board of Governors, but again they see these appointments in these regional lines also reflect different constituencies in those states. For instance, in US, you can find different constituencies in the form of Hispanic people, okay, people coming with different origin, they represent that. So to see that the diversity in terms of the community also been represented in this decision making process, through which they wanted to see much more diversified and representative decisions being made at each central bank level. So in a way, that model has worked in US and still working reasonably well. And other countries also started kind of taking some lessons from that type of arrangements. Okay. Then, of course, these 9 directors, they appoint one of them as the president and then gets the clearance of the Board of Governors in Washington. And this president is again on a rotational basis, becomes a member of FOMC. except in the case of President of the Fed Reserve New York, he is always a member of the FOMC. Right. Then you see this Fed Reserve system, right, mainly performs 5 functions. Okay. Fed Reserve system performs 5 very important functions. Okay. So you see number 1 and number 2 here in this particular slide that discusses the Fed Reserve system and 3 key system entities, right? So 3 key system entities, as we discussed, is the Board of Governors, the Fed Reserve Banks itself, 12 Fed Reserve Banks, and then the FOMC. Those are the key system entities in the case of US. And the overview of the Fed Reserve system, they perform 5 key functions in the public interest to promote health of the US economy and the stability of the US financial system. And what are these 5 major functions the Fed Reserve performs is, the first and foremost, as in every other central bank in the world, they conduct monetary policy. So FOMC sets US monetary policy in accordance with its mandate from Congress, that is Parliament in the case of Sri Lanka. And the objective of the mandate from the Congress to the Fed Reserve is they require to promote maximum employment. US is required, US Congress requires its Fed Reserve to make sure they promote maximum employment, stable prices, and moderate long-term interest rate in USA. In the case of Sri Lanka, we perform based on the MLA, the Monetary Law Act. Passed by the Parliament, and the key objective of the Central Bank of Sri Lanka is price and economic stability. Price is usually, you can call it here, stable prices in US case, fine. Price stability is low and stable inflation in a way. And then you see economic stabilities. You also see in the case of Sri Lanka, to see that the economy is using its productive resources to bringing better outcomes to its public. So it's not maximum using of productive resources. It's using its economic resources to improve the living standards of the country. So you see volatility is being addressed to great extent by bringing in economic stability. In a way, employment is also part of bringing in economic stability in the case of price and economic stability objective of the Central Bank of Sri Lanka. And the second and most important area in the sense of financial system stability, that's the second goal. First is price and economic stability, then you see financial system stability, thereby bringing in so-called stability to the financial market and financial intermediaries in terms of financial supervision and financial regulations, and now with macroprudential supervision and macroprudential related regulational activity. So you see in US, the conduct of monetary policy covers most of the elements, and then also they look at it from a promoting financial system stability also as one of their key functions. They monitor the financial system risks and engage at home and abroad to help ensure the system supports a healthy economy for US households, communities, and businesses. So they make sure the financial system supports their citizens, both within the country and outside the US, based on their one of their key functions that they are looking at. And they also look at supervising and regulating financial institutions and activities. So they look at the individual financial institutions, okay, and also they look at its impact on the financial system as a whole. So it is microprudential versus macroprudential. We discussed in one of our previous lectures. Individual institution specific as a system specific. And then US Federal Reserve also look at fostering payment and settlement system safety and efficiency. They wanted to make sure the systems in place for efficient payment and settlement arrangement in the country, and also they wanted to make sure its efficiency and safety. And it's there in the Central Bank of Sri Lanka's case too. We have the more or less the payment and settlement systems being maintained alongside all the banks and other financial intermediaries in operation through safer and sound payment structure in this country. So you can see all this RTGS, real-time gross settlements. Some probably prefer to see real-time net settlements. These are kind of, details that you don't need to worry, but that's how it operates. And then you see promoting consumer protection and community development. That also role of the US Federal Reserve System, and Sri Lanka also moving in that direction, because we have opened a new consumer protection department in the Central Bank of Sri Lanka only on 10th of this month, 10th of August. You see a press release. Last Friday, we have put it out, highlighting the role of this particular department. It is to promote, right, financial consumers, protection of financial consumers. So you see a direction in which most of the central banks work throughout the world. Federal Reserve System, they have 5 major functions to perform: monetary policy, conducting monetary policy, promoting financial system stability, supervising and regulating financial institutions and its activities, fostering payment and settlement system and safety and efficiency of those systems, promoting consumer protection and community development. So that's very broad, right? So other central banks also no different. They might not call it 5, they might call it 3 or 2, but broadly, everybody is engaging in this type of activities. Okay. Any questions? Right. So you see here, when it comes to the functions that they perform, you can't just call it clearing checks. I mean, checks are only a part of payment systems now. So efficient, timely clearance of payment systems is much more righteous way to say, instead of clear checks as one of the functions of Federal Reserve banks. They just call it clearing checks because it's a kind of a more conventional function, because today, more than checks, you use other forms of facilitation and electronic payments to great extent, because you see bulky big volume transactions instantaneously channeled through real-time RTGS or real-time net settlement systems now in place, right? And also another functions these Fed Reserve banks perform is issuance of currency. Everywhere in the world, the central banks or monetary authorities responsible for issuance of currency. So they also make sure they issue US dollars as required by the economy and economic activities. And also they clear off all these damaged currencies or mutually based arrangements to kind of take out defaced currencies, sometimes maybe through arrangements to clear the arrangements now with all this COVID related environment for the purposes of prevention of a virus spreading through currency modes. That also they are in today's context. But you can also remember in Sri Lanka's case, there were a lot of advertisements and public awareness in recent times to make sure people use clean clean currency arrangement in this country, and also defaced, willfully defaced sometimes, because sometimes you see currencies being used to used as love letters and to convey messages. Those been addressed, they've been taken out from circulation. You can write on currency. Some people, they sign, they do note down things, phone numbers, addresses, okay, they draw pictures, various things, but those also being taken out from circulation, and to bring in a kind of a more clean, not publicly used currency notes in the economic activity. So that's happening in countries irrespective of whether it's developed or developing or emerging. Everywhere they try to kind of make sure their currency is clean, and people are responsibly using the currencies for economic activities. And also the Fed Reserve administer and make discount loans to banks in their districts. I mean, it's the lender of last resort to some extent. You can access the Fed Reserve and then borrow money. And in the case of Sri Lanka too, they have very clear open market operations window, overnight lending facility. You can borrow from the central bank on overnight basis. That means you borrow today and you settle tomorrow. Or central banks conduct open market operations to have longer duration open market operations to inject money or absorb money, right? So you have to subscribe in the form of giving collateral that central banks accepts. More from the government securities they accept, and then you get the financing facility from the central banks through discount windows. Okay, so we have so-called overnight lending facility in Sri Lanka, and also we also have overnight deposit facility. The banks who has excess money, they don't lend it to people, but it's excess. So they bring those money and deposit in the central bank and get a return. It's 4.5% now. Overnight deposit facility. Okay, so through which the economic activities been administered to some extent, and the Fed Reserve also does this from the district Fed Reserve banks and of course branch cities that you all have familiar with. Also, they evaluate all these mergers of financial intermediaries, and also the proposals for expand banking and financial intermediary activities. They look into those stuff, and it's no different in Sri Lanka too, and many other countries. So you see the banking activities, these are very much general conventional activities. Okay, And also, more or less in recent times, the role of central banks also expand in the form of Fed Reserve acting as a liaisons between business community and the Fed Reserve system. So you see members itself being brought in the case of Fed Reserve in US as board of directors at different regions, Fed Reserve banks, to represent regional interests, regional industries. Their voice being heard to great extent at different decision-making levels. But still, they're bringing kind of a bridge to kind of a pass on the industry-related business community's concerns to the Fed Reserve, and through which for decision making. And in Sri Lanka too, as I said, consultative arrangements, and also to some extent inputs being shared through different arrangements to the central government for the decision making, even for budgetary processes and things like that. Okay. Then they also examine bank holding companies and state chartered. In US, you see nationally chartered, state chartered. We discussed those stuff. So state chartered bank member banks are there, so that the operations are restricted to the states in which that they've been chartered. Apart from nationally chartered, they can crisscross the boundaries of different states, and they play a national financial intermediation role. And these banks being examined, and their holding companies and their assets being examined by the Fed Reserve Bank. And even in the case of Sri Lanka, yes, the banks or the financial intermediaries, holding companies, books being evaluated, and their activities being monitored in the form of what type of activities the banks could expand into, right? You are not going to see the holding companies' books in Sri Lanka, but even in US, it might not be the case. But what you do is, at the time of expanding into different activities by establishing holding companies, you're bringing what type of activities you can engage in, what type of activities you should not be engaging. So that itself sets the direction very clear in the case of these financial intermediaries. And then, of course, you do all this data dissemination to make sure asymmetry being looked after. So to try business conditions being looked after very seriously by informed decision-making processes, right? Evidence-based decision-making processes through a collection of information and dissemination of information by the agencies. And it's no different in the rest of the world, not only in US, not only by the Federal Reserve, all the central banks does. And in the case of Sri Lanka, even the branch operations in Sri Lanka is carried out to see the local expertise being kind of looked at, and also the details being shared at grassroots level, right? So the central banks also use professional staff, economists, to do research and kind of bring in inputs for conduct of monetary policy and other related functions empowered with the central banks. And in the case of Sri Lanka, for instance, apart from conducting monetary policy, there are agency functions also vested with the central bank. Agency functions. Managing public debt, one of the very, very important areas of today's context in Sri Lanka and rest of the world, is also part of central bank's operation, because at the time of establishing the central bank in 1950, the Monetary Law Act recognizes that the efficiency of management of public debt would be much more professional and proficient in the central bank than in the government. And to great extent, it's true, because most of the problems in public debt that we are now seeing in terms of the big public debt volumes and all is nothing but because of a persistent budget deficit in this country, right? So you see the role that the central banks play, because they are mindful of overall macroeconomic circumstances, and they're bringing some discipline in terms of. But when it comes to budgetary, the governments would not necessarily look at the overall macroeconomic consideration. They would be ideally, but they might prioritize, given the circumstances, the expenditure flows irrespective of their revenue consideration. So these were very seriously debated in today's context. And you see the central banks all around the world is performing some agency function. As I said, in Sri Lanka, the debt management, and then of course the provident funds, employees provident fund and things like that, that also been managed by the central bank. Sometimes you do regional rural development activities. That is also a certain type of function that can be easily kind of a pass on to some other agency, but still the central banks perform. So you see they have these professional staffs to engage in this type of activities all around the world in terms of their operation. Okay, so the role in terms of conducting monetary policy of the Fed Reserve here. So the central banks, the Fed Reserve banks in US, they establish so-called discount rate, the rate at which the member banks or financial intermediaries can borrow from central bank or discount with the central bank is the discount rate. The discount means if they have financial assets, they can sell them to the central bank and central bank would borrow. Central bank would buy those by giving them a certain rate through which the price being determined, right? Or when they wanted to have liquidity, they can borrow from central bank by keeping collateral, mostly the government security. So the so-called the board of directors at different Federal Reserve banks, they established the so-called discount rate for this type of operation. In Sri Lanka, it's a single central bank, so you have the single rate that's been defined through monetary board's decision making. Okay, and also they decide which banks can obtain these discount loans. Usually, all the financial intermediaries, all the commercial banks can have access, and primary dealers, not specialized banks, saving banks in the case of Sri Lanka. All licensed commercial banks and primary dealers can access the open market operations window of the central bank in Sri Lanka. But in US, they also can have different arrangement. Some institutions can't, right? So they define that. And sometimes in US, they expand this to institutions. They are not necessarily financial intermediaries, but systemically important economic activities related institutions. In US, at financial crisis periods, they have facilitated such agencies also to access the kind of seasonal credits, the crisis credits, things like that through the open market operations. And now, to some extent, Central Bank of Sri Lanka also facilitate lending arrangements, special lending schemes to kind of facilitate the COVID-linked business entities, for instance, tourism and related industries, health and related industries, and also the government's non-settled construction, pharmaceutical related industries through government failed to pay them, although they have done the activities, but budget was not facilitated with funds allocated to settle their obligations. So they've been kind of extended with the special loan schemes, working capital facilities. They are extending in Sri Lanka. Okay, so you see the Fed Reserve and other central banks, they define this rate as well as what type of institutions can access these discount windows. That's quite common all around the world. Also, they see so-called the board of directors. They select, okay, in the case of US, one commercial banker from each district to serve in the advisory council, because they have advisory council, which consults with the board of governors and provide information to help conduct monetary policy. Here, it's not the case. In US, it's the advisory council conducts through members and kind of gives some inputs to the board of governors. Here you see the consultative committees. Okay, and then you see, as I said, 12 Fed Reserve Bank presidents have a membership and voting rights in the FOMC in conducting open market operation and making decisions with respect to federal open market operations in US. So these 5 presidents, as I said, out of these 5, it's 4 mainly comes through rotational arrangements. The New York president is a permanent member in the FOMC. Right? So this type of activities, what we are simply seeing is not different to Fed Reserve alone. Other countries also follow. Even in Sri Lanka's case, there are more or less the role being kind of established with stakeholder representation. And interestingly, this is not in Sri Lanka and often in other countries, but in US, you see member banks. Right? So all national banks are all national banks. Please remember, not state banks, because in US sometimes you see the states also charter commercial banks and their operation is restricted to that state alone. But in the case of US national banks, they require to be members of the Fed Reserve System. So usually they have all the Fed Reserve facilities. Then, as I said, you have state chartered commercial banks. They can, it's not being compulsory, but they may choose to be members. They can become members, but there is no hard and fast rule that they have to be members. But national banks, yes. And then, of course, in US, the reserve requirement, as I said, the reserve requirement we call in Sri Lanka a statutory reserve requirement, 2% now. If you have 100 rupees deposit in Sri Lanka, 2 rupees of that deposits they have to keep with the central bank as statutory reserve requirement. In US, they had this at different percentages for different type of financial intermediaries. But since 1980s, they have brought in same reserve requirement. It's fair enough. It's a unique number now in US also, right? So everybody has to keep a same reserve. And also they have extended the access to their Fed Reserve facilities to all the financial intermediaries. So you see in US, they have these arrangements, right? So they bring in those arrangements for these agencies to have their facilities being enjoyed. And these facilities to make sure the stability and of course, the liquidity requirements of most of these financial intermediaries, because you see when they have difficulties at times of financial stress and even systemically important financial agencies under normal circumstances, they could have difficulties, but that could spill over to other financial intermediaries. So the central banks all around the world facilitate, right? So we will get into more technical details as we move on. Okay, so another very important area in the Fed Reserve is one key institution within the Fed Reserve System is the Board of Governors. And in Sri Lanka, you know, it's the Monetary Board. And in the Sri Lanka's case, the law recognizes its Monetary Board as the person, not the Central Bank of Sri Lanka. the MLA, Monetary Law Act in Sri Lanka, provide all the powers to the Monetary Board, and Monetary Board is the person who represents the central bank in a legal sense in front of all these legislate, the legal kind of arrangement. So it's the Monetary Board is the person in the case of Sri Lanka, but in US it's the Federal Reserve Banks, and they have a board of governors, and one of the key institutional arrangement. And they have 7 members and headquartered in DC, Washington DC. And they appointed by the president and confirmed by the Senate. And each and every member appointed to the board of governors have a single term, but that term is 14-year non-renewable. But that does not mean everybody appointed stay entire 14 years there. They could resign prior to that based on their personal, or at times being requested by different policy arrangement, but they can continue. Once appointed, they can continue for 14 years. In US, the president's term is 4 years. So one president can contest for 2 presidential terms, so that means 8 years, right? So you see the 14-year non-renewable term to make sure that the independence of these members in the US case, irrespective of governments may come, governments may go, they may in power for a certain duration, a new government may come in and have different setup, but these members here in US Board of Governors have a longer term, and through which they can consistently follow their monetary policy directions that they have established. And also, as we were discussing, they require to come from different districts. They don't want to see all 7 members of Board of Governors represent one Fed Reserve district. No. Maybe 1 or 2, but generally, the widespread, diverse representation is encouraged, through which they bring in the inputs from different regions to the decision making. And the chairman is chosen among these 7 members and serves, although his term is a 14-year term for a member of the Board of Governors, but the chairman's term is usually a 4-year term and can be renewed. And often that happens for people who are very influential and very established, and they were continuously stand for the central bank and the financial system, not only in US, but across the globe. So you see the border spectrum here, and you see in the Central Bank of Sri Lanka's case, a term of a member in the Monetary Board and of the governor is a 6-year term. ST, Secretary of the Treasury, could have a longer duration. He been appointed as the Secretary of the Treasury and he becomes the member. So for him, it depends on how long he holds that Secretary of the Treasury position. But the governor, he could have a 1 term for 6 years and he could be appointed again. Fair enough. He could have another term. Other members also could have reappointed. They have renewable terms, but 1 term is usually 6 years. Right? So that's a kind of element in terms of a longer duration where they could have a continuity in their operations and engagements in the Monetary Board, irrespective of different governments in power, different interest of these agencies. So I mean, this independence aspect, we will look into the central bank independence as we move on. We can elaborate on that basis and try to understand intricacies underneath these as we discuss and continue this section of the discussion. And any questions you have? Right. So you see here these discussions, these elements, and I believe we will be stopping at this point because it is a good point for me to kind of start our next discussion. But one possibility next week, I may not have a direct class due to my some other engagements next week. So either it could be a recording, most likely. If not, they would make other arrangement. IBSL would make other arrangements, and you can follow up with IBSL. So I'll keep them informed. Either it could be a recording or kind of other arrangements to see. So get a kind of a handle on what the central bank's Fed Reserve's discussion that we had, and then try to see small comparisons at different points that we highlighted in line with the Central Bank of Sri Lanka and some other central banks in general. So we will continue this discussion as it is. And any questions, any further questions? If you don't have questions, we will stop at this point, and we will continue in our next class, either through a recording or from a different arrangement. Thank you.